Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, Harry Markowitz, the famous Nobel Prize-winning economist, once said that diversification is the only free lunch in investing. So what did he really mean, and how can you and I have this free lunch? Let's, begin this chat with what is diversification in context of mutual funds, and what did, when Markowitz said this, what did he really mean?
Investing is hard because it's very volatile. It's risky. Companies die. And how do you insulate yourself? It's reducing the risk and it is reducing the volatility because there's greater uncertainty. And it's also risk against not knowing something. You may not, for any human being, it is impossible to know most of the things about everything. And that is what investing is all about. You should know that, okay, this company will do this is how it will succeed, this is how it will fail, this is how, what will be the competitive advantage, how it will make money, and it will keep making money, and this is the point where it will stop making money. If you get it right, you really know the company and you'll make money. Or this is a fair price, this looks cheap, because if somebody would have known that here is a Infosys, which is a 100 crore company, and it is likely to become a 7 lakh crore company, and in the process it is going to do billions and billions of services, and it will keep growing at 15-20% for next 20 years, things would have been simple. But the fact is that it never happens in a straight line. It goes up and down, and people are nervous, sometimes excited. So it is diversification is the only free lunch. By that he means that it's a insurance against the volatility. It is insurance against the risk of many companies, because some companies might die, but you won't die because you are diversified. So that is what he meant by free lunch. And it is free lunch also because you will not know everything about everything. So knowing less or not being right about things, it is insurance against that.
Okay, and in the context of mutual funds, what does diversification actually mean?
If you have chosen to take the mutual fund route, if you want to invest in mutual funds, then there are two ways you can approach diversification. One is a passive way. You choose a flexicap fund, where the fund manager will take a call, or you choose an aggressive hybrid fund, where you have entrusted your money to a fund manager, and now he is allocating some money into fixed income and some money into, and remaining money substantially into equity, but across sectors, across different scale, different sizes of companies, or bigger companies are more stable, smaller companies are more volatile, but smaller companies have greater promise. So he's able to combine all that to optimize return. So you have delegated the responsibility of managing all of it to a fund manager. Once your money gets bigger, then you entrust your money to multiple fund managers. So you are able to de-risk against the failure or relatively not so great performance at all times by the same fund manager. Because fund managers also sometimes do well, sometimes do not so well. So as your scale, as an investor, as your scale grows bigger, you can do that. So you have these passive vehicles of achieving meaningful diversification at all times, which is aggressive hybrid fund, flexicap fund, multicap fund, large and mid-cap fund, value-oriented fund, or the tax-saving fund. These are all diversified vehicles. They don't come with any kind of restriction that they will not do this, they will not do that. They are supposed to, or they're designed to remain diversified at all times. Then there are narrower category. Narrower meaning large cap funds. They will be diversified, but they will be investing in big companies only. Small cap funds, investing in small companies and diversified, multiple sectors and all that. Here you have to really be little tolerant of extreme volatility. A small cap fund will tend to be more volatile. In bad times, they will crumble. And if you're fine with it, you can actually choose a mid-cap fund and a small cap fund and a large cap fund and have a greater control. In other ones, you will not have that greater control. Here you have given that control to a fund manager, and both of it is okay. Just that it requires, if you want to optimize your return, if you have greater tolerance, if you have longer experience, then you can well go for your large cap, mid cap, small cap yourself. Or you can go for large cap, small cap, mid cap, and then instead of getting a large cap, you can go for just an index fund and not having 50%, not having 70%, having only 30%. You think that you can withstand the extremes of mid cap and small cap yourself? Well, you can well do it. But keeping it simple, they also help you achieve 90% of the benefit of diversification, meaningful performance with that.
Okay. So now let's talk about, a few of them in detail. So let's go to multi-cap funds, flexi-cap funds, and large and mid-cap funds. If someone wants to diversify, can you draw a comparative analysis of what are these funds, what is the kind of mandate that they need to follow, and what are the risks and benefits?
Large and mid-cap fund is fairly straightforward. SEBI's definition for mutual fund is that top 100 companies in the country by capitalization are large caps. Next 150 companies are mid caps and all other companies are small caps. So this is the definition of that. Now, based on this definition or cutoff for large cap, mid cap, small cap, that is how mutual fund categories are set up. That flexi caps have the great flexibility to invest wherever they want to, no restrictions. And so they are go anywhere funds. They can invest in large cap, mid cap, small cap of their choice. They claim that they will be opportunistically investing in whichever category they want to, or they think that they are completely not bonded by anything. But the fact is that as flexi cap funds have become bigger, investing in small caps and large cap or mid cap stocks for those larger flexi cap funds, very big, huge flexi cap funds, becomes difficult. And that is why I find that more and more big ones have very small allocation to mid and small caps, and they are dominantly large cap funds, and that is where they have lost on the performance, and maybe understandably that they really can't do anything about it. Second is that the flexi cap and the multi cap, this is a very important and a crucial differentiation. Flexi cap funds are supposed to invest in large cap, mid cap and small cap at all times, but in any ratio they choose to, whereas multi caps are also like that, but with a rider that 25% should be in large caps, in mid caps, in small caps at all times. You have the flexibility only for the remaining 25%. So this fund can be 50% large cap and remaining in small and mid. This could be 50% mid cap and 25% in large and small, or it could be 50% small cap and 25% in mid and large. And also they are relatively new. They are new, relatively newer than the flexi cap fund, because after the classification, most of the flexi cap fund, most of the multi-cap funds actually turn into flexi cap. So that was more of a compliance thing. But these funds are relatively new. And my sense is that, funds being forced to have an exposure of 25% at all times in all the capitalization breakups will make sure that, these funds will eventually end up doing much better. Reason is that most categories, most large cap, mid cap, small cap, they turn around when you least expect it. And when they turn around, when they start doing very well, or when they stop doing very well, and it happens as a surprise. And when that happens, when you are forced to invest, you benefit from it. And anyway, you always have the choice of being selective with your choice, the kind of stocks that you would like to have. So I would say that being forced to invest in small cap and mid cap and not being carried by the flexibility, that enforced discipline actually comes in handy, and it will drive superior performance over time.
So you're saying multi-caps have performed better than flexi-caps and large and mid-caps? They tend to perform.
They are likely to be doing much better simply because of this rule.
Right. So which of these categories will be suitable to what kind of investor profiles?
I would say that, there is a hierarchy of things. As you get more sophisticated over time, and you as an investor, you gain sophistication only with your experience. To begin with, you have to start conservatively, because the biggest risk a new investor has is that he will be scared out of the market. His initial experiences, if they are very upsetting, so you start conservatively, and the conservative vehicle is, I think, flexi cap fund. They get you the flexibility and they are conservatively run. And don't invest in mid-cap funds to begin with. Don't invest in small-cap funds to begin with. And maybe, most people should graduate from flexi-cap funds to multi-cap funds simply to optimize return and this enforced thing. Because my opinion is that being forced to have this 25% in all of it will tend to be more rewarding over a period of time. So start with flexi-cap, end with multi-cap, and ignore the other ones, because every fund company goes about launching a category simply because they are permitted to. That doesn't mean that you have to necessarily invest in them.
Right. So how do you get optimum diversification? How many funds do you think, if I start investing in multicaps, how many multicaps do I have in my portfolio to diversify well?
For your 5,000 to 25,000 rupees, one multicap will do the job. Spend your time choosing that multicap. Once all your gradual allocation becomes 5 lakh rupees, then consider another one.
Okay.
Then in your accumulation journey, once it crosses 25 lakh rupees, then add a third one.
Okay.
This could be a nice way of having a method to addition. And there is no hard and fast rule. It is not that I have framed this rule and you have to follow it, or there is any such rule. Just that you are de-risking yourself against a fund manager doing poorly over a period of time and you having regret about it. Second is that that also does not mean that there is any hard and fast rule. If you have these two of them, and then in course of 3-4 years you think that okay, you should have this small cap as well, then don't add funds randomly. Be selective about it. And if you add it for a reason. But have 3-4 funds, and I think that can get you enough diversification. You can achieve it with 1, you can achieve it with 5, but don't have 50 of them, because the problem of 50 or problem of 20 is that you will end up having index. By virtue of having these funds, some sector funds, some thematic funds, some this fund, some that fund, which has been doing some well, 2 disadvantages. One is that you will end up having an index fund. And you will be incurring the cost of an actively managed fund.
Right.
Second is that you will not be interested in your investments once you have 50 of them. You have 5 of them, you are interested, it's doing well, why it is doing well, why when it's doing poorly. You worry about it. So remain worried at all times. Don't do much.
Okay, so 3-4 funds, that's
3-4
enough.
funds,
And what
5
about
funds is good
geographical diversification? Do we need to?
Yes, absolutely. Right now it has become difficult for Indian investors to invest abroad, but as and when it gets permitted, invest there. The reason is simple. The reason why you diversify is to de-risk yourself. The reason why you should diversify internationally is that you should de-risk yourself here as well. De-risk yourself and look for newer opportunity. There are companies which you can't really have it in India. So owning those stocks gets you promise, and owning that stock, de-risk yourself from the domestic market where we have our job, our assets and our investments as well.
Right. All right. So that's about diversification. Now here's a viewer's question that has come in. Ram Ditakavi says, I invest in mutual funds recommended by Value Research only for my retirement. In that context, what benefits does investing in active equity funds recommended by Value Research has over investing just in an NPS Tier 2 account, which seems to have better taxation and fund management charges?
Undoubtedly, NPS Tier 2 has the best, nothing can match their cost. And everything else being equal, lower cost is superior performance. But there is only one constraint, which is their investment universe is top 200 companies. They can't go beyond that. Maybe over time that might get relaxed. The Indian equity promise is much beyond top 200. If you look at the differential in return of the small cap fund and the mid cap fund and the large cap fund and the index fund, the difference is quite significant. And for a long-term investor, particularly targeting his retirement money, that could become meaningful. But that doesn't mean that for your retirement, you can't combine two. Have your 50% in NPS Tier 2 and have your remaining 50% in a bunch of small and mid cap fund. Thereby, you will have a diversified portfolio, and mutual funds expenses will not be as low as Tier 2, but it will certainly be lower than what we have been used to.
So that's all we have for you in today's episode. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.